To the Stage 3 tax cuts.
Stage 3 tax cuts.
Stage 3 tax cuts.
A couple of months ago, the Stage 3 tax cuts were announced, but there was a dumpster fire of backlash to the point they changed it. It's been circling the news for a while now, so you're probably aware of how it affects you. But how does it affect property investors? Here are two ways it might affect you. The Stage 3 tax cuts, set to be implemented in the 2024-2025 financial year, are part of a tax reform plan introduced by the Australian government. The goal is to simplify the tax system and reduce the tax burden on middle and high income earners. Do note that the Stage 3 tax cuts were changed almost immediately after it was announced, which attracted a lot of attention and debate online. We're not here to talk about what's better or not, though only updating those out of the loop and whether this changes the deductions from your property depreciation. For all this to make sense, you need to know how the income tax system works. We won't go through the nitty-gritty details of income tax, but in a nutshell, the more you earn, the higher your tax rate is. You can see the exact figures for the 2023-24 tax rates here on screen or on the Australian government website, which we'll link in the description. Using a basic tax calculator, someone earning $60,000 will pay roughly $11,067 in taxes. A $90,000 will pay $21,517 in taxes, and $180,000 salary will pay $55,267 in taxes. With the Stage 3 tax cuts, these numbers are now lower. A $60,000 salary will pay roughly $9,888. $90,000 salary will pay $19,588, and $180,000 salary, $51,538 in taxes. So the savings between the 23 to 24 versus the 24 to 25 financial year are $1,179, $1,929, and $3,729 respectively. Remember, these numbers are based off an online calculator and it doesn't consider your unique circumstances, which includes tax deductions, potential government grants, and other sources of income. But how does this affect property investors? Before I continue, it's important to keep in mind that this information in this video is not to be taken as financial or tax advice, and is actually all the more reason to see an accountant. First, tax deductions. This is the reason why it's so important to chat to an accountant, as property investing involves a lot of tax deductions. This includes things like your interest and depreciation. The amount of money you can claim back will shift. If you're precise with your numbers, you need to consider this, as although your overall tax bill will be less now thanks to the tax cuts, the tax deductions that follow may now also be less as a result, depending on your income and how close it is to the thresholds. The number will vary depending on your tax bracket and the amount you're claiming, but here's a quick example. Let's say you have a depreciation report for your 3-bedroom house. If your depreciation report says you're going to get a tax deduction of $10,000 for the 23 to 24 financial year, you'll save $3,250 if you're earning $90,000, $3,700 if your salary is $130,000, and $4,500 if your salary is $190,000. For the 2024-2025 financial year, you'll pocket this amount instead. $3,000 if you're on $90,000, also $3,000 if your salary is $130,000, and $3,700 if you're on $190,000. The differences are due to the updated thresholds. There's a reason depreciation is claimed over years instead of a flat amount. Tax rates and thresholds change every year. If you're precise and rely on your numbers to project your cash flow, knowing that these numbers can shift will be important. Not only that, but other tax deductions may shift you through to different thresholds, so again, see your accountant. If this is your first time hearing about depreciation schedules, watch our video covering what it is. But in a nutshell, your investment property and everything in it is an asset you paid for to make you money. Therefore, is a tax deductible, depreciable asset. The only way to determine the amount of depreciation without receipts is through a depreciation schedule. Next up, cash flow. With a slightly higher net cash flow, property investing may become a bit more appealing, especially for higher income earners who benefit more from this particular tax break. However, with the changes that disperse the tax savings to the lower income earners, the impact isn't quite as strong as it was when initially announced. You should see the debate online though. People are getting heated. Anyway, this means external factors such as interest rates, housing supply, and cost of living may balance this out or even outpace the effects of the extra tax savings. If this does make property investing more appealing, expect even higher demand, increasing your average property prices. This one is speculative, but this may also affect the rental market. In a vacuum, with a higher cash flow for everyone, the rate of rent prices may increase since the purchasing power of consumers also increases. But again, the world isn't so straightforward, and other factors can still affect rental prices, including general housing supply, geographic variation, interest rates, and general cost of living. Overall, the most significant impact these changes will have is that although the overall tax you'll be paying is less, so will the tax deductions you'll receive. So again, make sure you see an accountant to see what's affected and avoid getting caught with your pants down thinking you'll save a flat amount from some online calculators. It might not be as much as you think. Remember to leave a like, and if you have any questions or opinions on the latest tax cuts, leave a comment below. Otherwise, I'll see you in the next video.